I've been told I have 29 minutes for this talk, and for me, 29 minutes is how long it takes me to get warmed up. But when I was asked to do this talk a few months ago, I was asked whether I'd come to Oslo to do the talk. And I said, it took me about 2 seconds. There, no way am I flying all the way across to Oslo to give a 29-minute talk. But I'm glad to be in front of you today. And the introduction said when there's uncertainty. So let's start with a very basic reality check. If you feel you live in uncertain terms, what makes you think you're special? Even in just the 40 years that I've been teaching, every 3 or 4 years, I've been told these are especially uncertain times. The truth is, uncertainty is a feature, not a bug of investing. It's always been there. And as I will argue a little later, be glad that there's a lot of uncertainty, because if there were no uncertainty, there would be no need for you as active investors in this game, right? I mean, if you trace back the history of uncertainty, you think about the cave people, their uncertainty was physical uncertainty. Will I be able to get enough food to survive? You move to the Middle Ages and you think about those ships leaving Europe to go to Asia to get spices. The uncertainty was whether your ship would make it around the Horn of Africa, whether you'd get scurvy, and whether you'd make it all the way to India. It's only in the last 300 or 400 years that you've had a separation of physical uncertainty, which is what we felt for the bulk of our existence on this earth, to financial uncertainty. Uncertainty is part of the game. And the truth is that we as human beings don't deal well with uncertainty. In fact, let's think about the classic responses to uncertainty. And I'm going to trace it back to investing in valuation, and you can tell me whether you can relate. You know, the first reaction to uncertainty is paralysis, denial. You know how often I've talked to people who say, you cannot value young companies. And why not? Because there's a lot of uncertainty. That's nonsense. But the defense that people offer is, in the face of uncertainty, I'll stop doing things. The second is we use what I call mental shortcuts. When that VC uses price per user to attach a value to a company, he's using a shortcut. He's basically saying, I can't deal with uncertainty. I'm going to make up stuff. The third is herding. You look to see what other people are doing and you go with whatever they're doing. Don't undercut it. I mean, 90% of active investing is looking for a crowd and joining in, right? Let's be quite honest. If you think active investing is some kind of unique experience where you're going out and doing original work, 9 times out of 10, active investors look for a crowd and they join in. The fourth response to uncertainty is what makes consultants happy. You feel uncertain as a company. You know what you do? You call in McKinsey, as if they know what the future will deliver, but they will charge you several $1 million for telling you what to do. And if things go wrong, you can always blame McKinsey. And don't forget the oldest response to uncertainty. This has been around as long as time. Faced with a lot of uncertainty, what do most of us do? We get down on our knees, we look towards the heavens and say, please, God, tell me what to do. Should I buy that growth stock? The reality is uncertainty is always with us. It's what we do in response to uncertainty that creates the kinds of problems in investing in valuation that I'd like to talk about. So here's my first step in dealing with uncertainty. And I'd strongly recommend this step for all of you who have to deal with uncertainty in investing in valuation. Don't look at uncertainty collectively. Now, in fact, one of the things I ask my people to do when they look at a company that they're trying to value is make a list of everything they're uncertain about. And guess what? You're uncertain about everything, right? Who'll be the CEO of the company? What will the margins look like? What's growth going to be? After you've made a list of every risk you think you will face in a company, I want you to start putting the risk into boxes. You're saying, what are you talking about? I'm going to categorize uncertainty and deal with uncertainty very differently depending on which box it's in. So here's the first grouping of uncertainty. Uncertainty can either be estimation uncertainty or economic uncertainty. Let me draw the difference. Estimation uncertainty is uncertainty you feel about something you're estimating, where doing more work, collecting more data, doing more analysis will reduce the uncertainty. Economic uncertainty, there's nothing you can do about it. So for instance, coming into 2023, one of the big uncertainties we face is what will inflation do during the course of the year? I'll be quite honest. Nobody knows. Not the central banks, not the experts. That's economic uncertainty. It's hubris to think that if you build a bigger spreadsheet, add more inputs, you can make economic uncertainty go away. And I have some really bad news. 90% of the uncertainty you face in valuation is economic uncertainty. Building a bigger model, having more inputs is not going to make that uncertainty go away. Estimation uncertainty versus economic uncertainty. The second grouping of uncertainty I'm going to call micro uncertainty versus macro uncertainty. Micro uncertainty is uncertainty you feel about a company, who's running the company, its business models. Macro uncertainty is uncertainty you feel about the economy, about big trends. Let's take Tesla. It's one of my favorite companies to value. In fact, I've called Tesla my corporate teenager. Every morning, the company gets up, looks in the mirror. Actually, one person in the company gets up, looks in the mirror and says, I've got lots of potential. What can I do today to screw it all up? And I won't name the person. Lots of uncertainty, right? There's a lot of micro uncertainty at Tesla about the company, about its business model, about its management. But there's also a lot of macro uncertainty about Tesla, right? How many people will switch to electric cars? What will the future bring in terms of fossil fuels? What will climate change look like 5 years from now? Micro versus macro. You're saying, who cares? It's only macro uncertainty that should show up. If you're doing an intrinsic valuation, you think about discount rates, it's only macro uncertainty that shows up in your discount rates. Why? Because micro uncertainty can be averaged out. This isn't rocket science. It's statistics 101. It's the law of large numbers. You invest in 100 companies with a lot of micro uncertainty in each of them, your portfolio will look a lot more stable than any of those individual companies. Micro versus macro uncertainty. And the final grouping, I would argue, is between discrete and continuous uncertainty. Continuous uncertainty is uncertainty you feel every moment of every day. Your numbers keep moving on you. Discrete uncertainty you don't feel for the most part until the day you feel it. I'll give you the classic example of contrasting discrete versus continuous uncertainty. If I'm a US company that gets 40% of my revenues in Europe, every time the euro-dollar exchange rate changes, my earnings and cash flows are changing, right? Continuously. In contrast, if I'm a US company invested in a country with fixed exchange rates, most of the time, nothing happens to the exchange rate until that day I wake up and I see a 60% devaluation. I'll make a confession on the part of all of finance. We're very good at dealing with continuous uncertainty in finance. Every risk and return model you see in finance is designed to deal with continuous uncertainty. You know what we're not very good at dealing with? Discrete uncertainty. We're not good at valuing distressed companies. We're not good at dealing with nationalization when we value companies in countries where that's an imminent risk. Continuous uncertainty versus discrete uncertainty. I'll talk about tools if I get a chance of dealing with each. But the first step in dealing with uncertainty, getting in control, is breaking down uncertainty into its component parts. So let's do a couple of reality checks when it comes to uncertainty. One of my favorite devices when I talk about valuation or corporate finance or investing in general is a corporate life cycle. I describe Tesla as a corporate teenager, and I use those words intentionally. When I look at companies around the world, I put them somewhere in the life cycle. If you think about the life cycle for a company, here's how it begins. A startup is like a baby. It's like a baby. Needs constant care and attention to get through, right? Lots of capital. Think of that as mother's milk of startups. Very young company is like a toddler. Falls, gets up, sometimes falls and doesn't get up. Then you become a corporate teenager. You do things that are unpredictable and sometimes unforecastable. And then you enter the peak of your life. At each step, though, there's a lot of mortality. Companies die. If you make it to the peak of your life, everything you touch turns to gold. Think of Facebook 5 years ago. Everything they touched turned to gold, right? Everything was profitable. Enjoy the moment while it lasts because you're going to age like every other company in history. And Facebook now is approaching middle age and it's having a middle age crisis. Enjoy middle age though, because worse things are coming down the pipe. Because after middle age comes old age, and after old age comes death. I know it sounds morbid, but companies go through this life cycle. You look at GE, it's a walking dead company, right? A lot of zombie companies wandering around Europe, to be quite honest. You're saying, why does this matter? The types of uncertainties you face in valuing companies will depend on where your company is in the life cycle. When you value a young company, you're going to face a lot of micro uncertainty, uncertainty at the level of the company, a lot of discrete uncertainty because your company might not make it, and a lot of estimation uncertainty. As companies mature, the uncertainty will shift from micro to macro, from discrete to continuous. It's not that uncertainty goes away, it just gets different. It does get more manageable. Now, do you see why when people want to avoid uncertainty, they keep valuing mature companies over and over? I have a great deal of respect for Warren Buffett. I have very little respect for those people who go to Omaha and view every word that comes out of his mouth as gospel. I think value investing, at least the way it's been practiced, has lost its way because it's so focused on avoiding uncertainty that the only companies you feel comfortable valuing are mature companies well past their due date. So you be you, keep valuing Coca-Cola and Kraft and Heinz over and over again, saying those are my best investments. But guess what? You're avoiding the issue, which is by staying with companies where you have less uncertainty, you're avoiding perhaps the best investments out there. So with that lead in, let me talk a little bit about how I think about valuation. In valuation, I think we've turned valuation over to Excel ninjas. I shudder at how valuation is practiced in investment banks. Huge Excel spreadsheets running analysts rather than the other way around. When I think about the value of a company, I can boil down the value of any company, no matter how complex or where it is in the life cycle, into 6 basic inputs. 6, that's it. Let me go through the 6. 3 of these inputs describe your business model. The first is revenue growth, captures the growth part of your business model. The second is operating margins, captures the profitability part of your business model. And the third is how much you need to reinvest to get that growth. Remember to tie up that loose end. Growth is never free. Sales, revenue growth, margins, reinvestment, drive your cash flows. Now you got to fund your business, and you can fund your business in only one of 2 ways. You can raise equity, you can raise debt. Equity has a cost, and I won't bore you with different risk and return models. To me, models are a means to an end, but you need a cost of equity and a cost of debt. And that gives you a cost of capital. And there's a 6th and final input. Remember we talked about mortality? If your company there's at least a chance your company will not make it, you cannot bring it into your discount rates. Discount rates were designed to capture continuous risk. You need to bring in a failure risk. When you value a startup, you can do a discounted cash flow model, but remember, 2/3 of startups don't make it. You got to bring in a failure risk. Now, with that big picture perspective, I'm going to very quickly take you through 3 valuations so you can see the challenges in valuation shift depending on where the company is in the life cycle. The first is a company called Zomato. Zomato is an online food delivery company that went public in India in 2021. I valued Zomato at the time it went public. It's a very young company in a market that's young and evolving. Food delivery in India is still a young and evolving market. I'll cut to the chase. I won't bore you with the details, but when I valued Zomato, everything was uncertain. In fact, their basic accounting statements told me almost nothing about the company. I'm a great believer in connecting stories to value. When you value young companies, it's about telling the right story. Narratives drive your valuation. So when you face a lot of uncertainty in young companies, remember, you're not special. Everybody faces that uncertainty. Don't fall behind that, hey, you cannot value young companies. You can, but you have to tell a story. My Zomato valuation reflects my story for Zomato as a company in a market that's going to grow over time and dominate that market. That's embedded in that story. You see my revenue growth, my margins. It's an upbeat story. And to cut to the end of the story, the value that I got for Zomato was about 40 rupees per share. At the IPO, it was priced at 72. It went public at 110 on the opening day. It briefly went as high as 160 rupees. A year later, it was back at 40, but I wouldn't claim redemption. I just got lucky. But my point is, just because a company is a young company, you cannot hide behind, hey, there's too much uncertainty. You have to make your best estimates. The second company I'm going to value is Unilever, a company that's been around, a mature business. Boring story. I mean, what are you going to tell about Unilever that makes it exciting? I know they played the stupid game with ESG acting like mayonnaise can ever be something that makes society better off, but the reality is this is a company running in place. Valuing Unilever was a lot easier than valuing Zomato. You know why? Because you take your financial statements for Unilever and do projections. These are the kinds of companies that the Excel ninjas love. You can do financial modeling and value the company because not much is happening. And finally, the third company I valued was a company called Bed Bath & Beyond. A horrific nightmare to shop at if you've ever been in a Bed Bath & Beyond store, but a company essentially walking towards its grave when I valued it. And the news stories in the last couple of weeks, it's actually probably in the grave halfway now. In the case of Bed Bath & Beyond, I still made estimates. There was a lot of uncertainty about whether the company would make it. It's a brick and mortar retail company in a landscape where brick and mortar retail companies have been devastated. Different kinds of uncertainties. My response is to deal with the uncertainty and bring those what I think about a company into those core inputs. Keep your valuation simple in the face of uncertainty because complexity will get you into trouble. So with that long lead in, let's talk about the macro part of company valuation. Macro part, let's face it, we face a lot of macro uncertainty. Uncertainty about inflation, about interest rates, about exchange rates, about the economy. And you could argue that at the start of 2023, we're in the heart of a storm. Every single one of these inputs is uncertain. And of course, the tool we have is a blunt one, right? The tool we have to deal with uncertainty is discount rates. And you know where in the discount rate we reflect this uncertainty? We reflect it in a risk-free rate and risk premiums. I'm almost obsessed with equity risk premiums, as some of you know. And the reason I do it is it becomes my vehicle for dealing with macro uncertainty because it is my only vehicle. And we're coming off a year where there's been a great deal of uncertainty. I'm going to give you a very US visual thing, but you could argue the same thing is going to be true in Europe. Last year was an eventful year for risk-free rates. The T-bond rate went from 1.5% at the start of the year to 3.88% by the end of the year. That's a pretty big jump, more than a doubling of T-bond rates in 1 year. I've heard people say, well, rates are high now. Well, that's because they're young. I remember when 3.88% was the norm. Maybe we're returning back to a normal rate. But the fact is, during the course of the year, risk-free rates changed. And during the course of the year, so did equity risk premiums. For those of you who visit my website, I update the equity risk premium for the S&P 500 at the start of every month. And last year, the equity risk premium for the S&P 500 went from 4.24% at the start of the year to almost 6% by the end of the year. You bring those two components together, risk-free rates rising by more than 2% and the equity risk premium rising by 2%. Last year was the biggest change in cost of equity and expected returns I've seen for US equities in the 50 years I've been tracking this number. So with that long lead in, you're saying, what do I do about those? There's really nothing you can do. You can't normalize risk-free rates and risk premiums. The way I describe this is you got to live in the world you're in, not the world you wished you were in. So if you've been using historical risk premiums and normalized risk-free rates, stop. Just update the numbers to be what they are now. We're also at a unique moment in terms of economic growth and whether there's going to be a recession. Again, don't play God. Don't try to bring in your views on the economy into every company valuation, because then you will have a joint effect of what you think about a company and what you think about an economy. So I have a couple of pieces of advice for you if you're dealing with macro uncertainties. First, be macro consistent. You say, what are you talking about? Let's take inflation, right? Let's say that you believe inflation is going to go from 4 to 7%. You have a point of view. You decide to bring that into your valuation. Okay, it's your point of view. It's a dangerous thing you've done. But if you put in an inflation rate of 7%, you can't leave the risk-free rate at 4%, because if you're right about inflation being 7%, risk-free rates are going to rise to 8 or 9%. You cannot change one macro variable without changing everything that's connected to it. That's what macro consistency requires. And especially in the context of inflation, you don't have to get inflation right. You just have to be consistent about bringing in inflation into both your cash flows and your discount rates. I do a long session on why, if you do things right, your valuation should be currency invariant. In other words, I value a company in Turkish lira, and in euros, I should get the same value for the company. You're saying, how can that be? Inflation rate in Turkey is 70%. You know what? That 70% should show up both in my cash flows and my discount rate. It comes from inflation consistency. My stronger recommendation, though, is keep your focus. I want you to value companies, not give me your macro views. Now, of course, if you're an active investor, you might hire a macro person to give you macro views and make your asset allocation decisions based on that. But you don't want an individual analyst walking around with strong macro views, because then you're going to get a mess in your hand, because you're never going to know whether an analyst is finding a company to be undervalued because they think that this is a good company, or because of their macro views. And especially in the context of commodity companies, this shows up in your view of commodity prices. So I just have a couple of minutes left. I want to talk a little bit about tools for dealing with uncertainty. Since I'm not going to get a chance to deal with all of them, let me at least list your choices. The classic choice for dealing with uncertainty is risk-adjusted value, right? Push up the discount rate because you face a lot of uncertainty if it's macro uncertainty. If it's micro, assume it gets averaged out. That's the practice we've taught in valuation classes for as long as I've been teaching. But I do think we underutilize statistical techniques that can help us deal with uncertainty. In fact, let me list out 4 potential techniques you can use for dealing with uncertainty. You've all done what-if analyses, right? You do evaluations of what if this, what if that. To me, it's one of the most pointless exercises in valuation, because it leaves you more uncertain after you've done it than before. There's one version of what-if analysis, though, that I think is useful. I know how many of you have read this book, Expectations Investing, written by my really good friend and person I have a great deal of respect for, Mike Mabusson and Al Rappaport. And here's what they do in their book, and I'd strongly recommend you try this too. You know how in traditional valuation, you make assumptions about cash flows, growth, and risk, and you value a company, you compare to the price? They go one step further. They ask a question. They say, well, what will the growth need to be for the value to be equal to the price? That's the expectations game. They're trying to back out of the price what the imputed expectations are from the market. You're saying, what do I do with that? Let's say you're estimating a growth of 7%, but the market is imputing a growth of 30%. Question you got to ask yourself is, am I comfortable enough with that difference to take a stand on my valuation? So that's what-if analysis with a purpose. The second is scenario analysis, particularly useful when you're faced with a macro environment where if something changes, your value could change dramatically. I'll give you an example, and you can check this out in the notes. I had to value EasyJet in 2019. I was doing it for a UK audience. It was just ahead. I mean, this was when Brexit was in complete shambles, right? We had no idea how this would play out. And EasyJet, as a UK airline that gets half of its revenues flying Britishers to European sunny locations, was especially exposed to how Brexit would play out. So you know what I did? I valued EasyJet with hard Brexit, soft Brexit, or no Brexit, attached probabilities to the 3 scenarios, and came up with an expected value. You got to complete the game. You can't run scenarios without tying up loose ends. The third are decision trees. These are particularly useful when you're valuing multi-stage risk. Place that I find this most useful when you're valuing a young pharma company, with the drug working its way through the pipeline. It could get approved, not approved, 3 stages. Decision trees are useful to deal with that kind of risk. It does require that you make estimates of probabilities of success or failure, but you should be doing that anyway. And there's a final tool that I've become very fond of. It's called a Monte Carlo simulation. In fact, almost every valuation that I do an add-on of you're saying, what's a Monte Carlo simulation? You know how in traditional valuation, you're asked to make point estimates. What's your revenue growth rate going to be? Give me a number. What's the margin going to be? Give me a number. What's the discount rate going to be? Give me a number. And part of you is screaming, but I don't want to give you a number. I want to give you a range. You know what? With the Monte Carlo simulation, I'm going to allow you to give me a range with a distribution. So you can say, my revenue growth rate is going to be 20%, but it's uniformly distributed between 15 and 25%. My cost of capital is 7.8%, but it's normally distributed with a standard deviation of 0.3%. You give me distributions for the inputs. In a Monte Carlo simulation, I essentially draw an outcome from each distribution, revenue growth margins. I come up with an estimated value of those outcomes. And I do this over and over and over again. 10,000 times. Each time I get a different value, I give you a distribution of value for the company. You think, what do I do with it? As an investment manager, think of how much more useful it is for me to tell you not only that a company is undervalued, but what the likelihood of undervaluation is, what the 30th percentile. So essentially, I can give you a lot more information to make your judgment calls than giving you a single number. You think, why have we always done this? 40 years ago, you couldn't have done it. Why? Because it would cost you millions of dollars to run a Monte Carlo simulation. You'd have needed access to a mainframe. Here's where technology has helped us. I use an add-on called Crystal Ball. And what it does, it's an add-on to Excel. It converts every Excel valuation that I do into a simulation. It allows me to do it. It still requires me to make the judgments on distributions. But Crystal Ball does the rest. Its default is, I think the default is 10,000 simulations. I can make it 100,000. If you get a chance and visit my website or my blog and check out some of my recent valuations, especially the Zomato valuation, you'll see my Monte Carlo simulations. Let's face up to uncertainty. Stop hiding from it. And I'm going to leave you with a parting thought. Before you bitch and moan and whine about how much uncertainty you face, be glad you live in a world with uncertainty. Here's why. I asked people whether they'd prefer to be weather forecasters in Honolulu, Hawaii, or Epping, North Dakota. You think, why that contrast? Honolulu, Hawaii is the most predictable weather in the world. Epping, North Dakota is the most unpredictable weather in the US. If you're a weather forecaster and you go to Honolulu, Hawaii, you know what? Nobody needs you. Everybody knows what the weather is going to be tomorrow. You go to Epping, North Dakota, even though you're going to be wrong and terribly wrong sometimes, everybody's going to listen to you. The need for active investing increases as uncertainty increases. So be glad you live in a world with uncertainty. That's about it. I've run out of time, so I'm going to open up to any questions you might have. But thank you for listening.
Thank you so much, Aswath. We have several thousand people in our classroom today, but many of them are eager to ask questions, and I've invited one of them to start this off, and he's the CEO of SKAGEN Funds, Tim Warrington. So now, Tim, here is your chance.
Brilliant. Professor, good morning, and thank you very much indeed. Clearly, my colleagues on the investment team in SKAGEN have a sense of humour, because they nominated me to be the one that should handle this part of the session. I am not known for my valuation skills, nor am I known for my use of Excel, and more than one can attend to that. I do now understand, having listened to you for the past 29 and a bit minutes, why Robert Armstrong of the Financial Times said last week that basically when he grows up, he wants to be you. And I certainly feel somewhat uncertain taking on this role now. In the same article, Robert also said that your valuation of your corporate teenager was far and away the best one that he'd seen, and clearly it's been the gift that's giving and keeps on giving for you. At the time, I seem to recall you valued Tesla at around 650 billion.
Right.
It's now trading, I think, somewhere below 400.
390 or
390. So. How would you mark your work now? Are there any reflections that you have on those earlier valuations that you made?
You know, one of the problems with Tesla has always been that it's tied to a personality. And I'm always a little wary about valuing or investing in companies where you don't know where the company ends and the personality begins. And, you know, of course, you know who I'm talking about. You look at anybody who's a believer or a non-believer in Tesla, it's really all about Elon Musk. And I think right now, the biggest concern that I would have in looking at Tesla is, you know, the company's been tied so closely to a person, and that person seems to be otherwise occupied. My concern is that that there's nobody running the ship, you know, running the company at Tesla. So I need some kind of affirmation that Tesla can operate as a company independently of Elon Musk. I think they can do it, but it'll require Elon Musk to give up some of his ego and let somebody else step in and be the operating person running the company. So at 390 billion, I'm in no hurry to buy the company yet because I'm planning to come up with a reassessment of value in the next couple of weeks. But that reassessment has to reflect where I think the company is going and what I think is going to happen to this link between personality and company that I think has brought the company down. So at this point, for the first time in Tesla's history, I'm not sure whether Elon Musk is a net plus or a net minus. And that's a big shift in where we were a couple of years ago.
Very clear. Thank you. One of our attendees has asked the question, I think something of a follow-on to what you've just said. How would you generally consider the importance of technological change, particularly when innovation is happening at pace? How do you include that or account for that in the valuation of companies, I mean, such as Tesla, for example?
One of my theses has been that the corporate life cycle is shortened. I describe tech companies as aging in dog years. What that effectively means is many of the things we teach in business and valuation were designed for the classic 20th century company. I'll give you an example. GE, classic 20th century company, founded in 1891. I'm not sure when the death date will be, but it's approaching. But it's lasted 130 plus years. So in traditional valuation, one of the things we do is we project out cash flows for a period. The end of the period, we assume the company will keep going and going forever, and we estimate a terminal value. This is a classic way we teach discounted cash flow valuation. That works fine if your life cycle is 130 years. I think if you look at, in contrast, a company like Yahoo, founded in 1992, date of death, probably 2015, 23 years from start to finish. I think the 21st century company that you're valuing is not going to have a 130-year life. It's more likely to have a 25 to 30-year life. So when you get excited about a new company, what could be? It could be Rivian, it could be Tesla, it could be a software company that you realize, Snowflake. Even if it's successful, it's not going to have the kind of life that the 20th century company did. So when you value these companies, you might want to value them with finite lives rather than the perpetual life assumption. You got to assume that the good days will end. So when people look at Facebook and say, I never thought this would happen, they should remember MySpace used to dominate this before Facebook came along, and somebody else would dominate the social media space after Facebook leaves. So I think the speed with which things are changing have to get reflected in the way we think about companies, the way we invest in them, the way we value them. It'll also show up in the metrics that get used in investing, things like PE ratios and EV to EBITDA. You can't assume mean reversion is going to save you, which is the traditional way we invest in the 20th century. In the 21st century, there may be no mean reversion in some of these companies because they're reverting towards zero.
Thank you. Something of a local question here. How should one take into account historically high oil prices when valuing an oil company today? One might think that the downside in price is bigger than the upside by looking at prices from the past 10 years or so.
I think mean reversion is extremely dangerous with oils for the simple reason. We're in the midst of climate change. I'm not a great believer in ESG, as many of you know, but I do believe that The traditional cycle that's driven oil prices is broken. 30 years ago, if I asked an oil company executive or an oil analyst, what's a normal oil price? I got a pretty consistent answer. In the 1980s, it was $25. In the 1990s, it was $40. Today, I think if you can talk to oil analysts and people who run oil companies, they've lost a sense of what a normal oil price is. So when you say historically high oil prices, my sense is over what history? Because you go back 50 years, you get a very different historical. So this notion that there's a normal oil price, I think, is increasingly slipping away, which makes it more difficult to value oil companies. But guess what? Everybody's going to face the same issues that you do. You're not special in that sense. You've got to do the best you can and kind of move on. But I don't think that we have a sense of a normal oil price anymore. And I don't think we ever will.
Thank you. One listener online has asked, what is the biggest mistake that you observe investors make?
I think most investors are traders. Not traitors, but traders. In other words, they're not
traders,
investing,
yeah.
they're trading. The essence of trading is you buy low, you sell high, you play games with pricing metrics, you look at technical analysis, and there's nothing wrong with it. The biggest mistake that people make is when they are delusional. Traders who act like they're investors. So when I see an analyst get on CNBC, and I know the analyst is a momentum trader. Basically, they pick stocks that have gone up the most, put buy recommendations on them, and talk about fundamentals. My response is stop being delusional. If you're a trader, talk about things that drive trading. If you're an investor, focus on investing. Don't talk to me about what the market is doing and pricing factors. Talk about the fundamentals of the company. So I think the biggest mistake we make is we delude ourselves into believing we're something we're not. Investors who act like traders and traders who act like investors.
Splendid. I'm certainly not going to be deluding myself. If you had to choose one company to invest in based on those that you've been looking at over the past year or so and stick with it through 2023, which would it be and why?
To me, 2023 might be too short an end time, I know, but I would buy Amazon at today's prices. I mean, I've described Amazon as the equivalent of Thanos in the Avengers, which is, it's a company that is, it's not a retail company, it's not a logistics company, it's a disruption machine. And I think that at the price it was trading at a year ago, I might not have bought it, but at today's prices, I'd go for Amazon.
Very clear. Thank you very much indeed. And I think an interesting and perhaps a behavioral question. Would you be as good as a teacher without investing? And would you be as good as an investor without the teaching?
No. I think that you cannot teach investing in valuation without doing. Because this is not, there's not a whole lot of theory in valuation. So I've never believed in talking about valuation without being willing to act on my own valuations. So the answer is absolutely, the two are tied together.
Splendid. And the last one that's come in from within the room, you distinguish between discrete and continuous risks. And we're very clear that investors, we tend to be better at the latter, although arguably the former is far and away the more important. How does one improve at assessing and handling discrete risks?
I think we need to get away from the details, get a broader perspective. I think one of the things that happens in investing is you get so close to markets and what's happening in markets right now, it's very difficult to step back and gain perspective. Discrete risks require that you have historical perspective, data perspective. So sometimes just stepping back from the day-to-day movements in markets might be the first step in dealing with discrete risk. We could learn a great deal from the insurance business, not looking at insurance companies, but the insurance business, because this is what they've been doing for 500 years, right? Dealing with discrete risk, coming up with premiums that reflect it. We need to start thinking on those things. Maybe some actuarial skills are what we need to bring to the game.
Splendid. Thank you very much indeed, Professor.